let's delve into the local markets. Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers, joining me in studio. Thank you so much for joining us today, Andrew.
Thanks for having me.
So the Shoprite share price down 6% on the day. I mean, I can't remember the last time we saw a large cap company like this being hit so sharply, and it seems that 14% growth, not good enough in terms of where the stock is trading right now. That's of course for the first half of the year. What did you make of that trading update?
Yeah, I mean, it's a well-known fact the retailers are exceptionally expensive. Foreigners have been selling resources over the past year and putting that money into your retailers, food retailers in particular. And when you've got Shoprite trading on a forward PE of in excess of 25 times, the earnings numbers or your trading updates need to be exceptionally good to maintain or support those sort of multiples. So it's no surprise to see the stock come under pressure when earnings or revenue rather is only up 14% for the 6 months.
Now Shoprite has around 1,670 or so stores in South Africa and 214 odd stores in the other 16 African countries. Now that really just indicates where their base still is. It's very much South Africa, even though everyone's optimistic. I mean, the front cover of the Financial Mail got Whitey Basson, pioneer, leader when it comes to African retail. So when is Africa going to really show up in the numbers? I mean, what's the timing of this from your perspective?
I mean, there's a lot of noise has obviously been made about the Africa story, and I think that's why you've seen these multiples trading where they are. And it's not just Africa, it's emerging markets. You look at Naspers, is another case in point with its China exposure. When is this going to come to the fore? That's a very good question, which I wish I had an answer for. I think it's quite a few years away, or a number of years away rather. You look at the earnings now from Africa, I think make up about 10% of Shoprite's earnings. Mm-hmm. That's still quite a small amount. And although you've seen earnings up 28% or revenue up 28% from its operations outside of South Africa, that's still, I think the market still expected more. Given the multiple trades.
Just talking about China, I mean, you mentioned the fact that Naspers, of course, trading off that optimism around China. Richemont, 73 Rand almost today, and just continuing to head higher. And then you contrast that to resource stocks, which some of them are still trading below 10 PEs. Are resources going to now catch up to the likes of the Richemonts? I mean, why the disconnect when it comes to those more consumer-based stocks?
Yeah, we think the truth probably lies somewhere in the middle. It doesn't quite make sense that you've got Richemont that's done exceptionally well, the Chinese consumer buying luxury goods, watches, etc. But then investors are saying that China's in for a hard landing, there's not going to be demand for resources, and we've seen resources at a 20-year low. I think you have to go back to the early 1990s to see resources trade at the levels they currently are. We would hope to see a correction in this from this point of view. I think last year resources were flat, industrials were up 30-odd%. We think they're exceptionally expensive, and we've seen the same disconnect here in South Africa with retailers being priced where they are. You'll expect the South African consumer to be quite buoyant. However, your construction stocks are priced as if they're going to go out of business next month. So again, the truth is probably somewhere in the middle. Consumers or retailers, I don't think, deserve the ratings that they're on at the moment. Likewise, construction doesn't deserve to be trading on a single-digit PE. Probably somewhere in the middle, but there's a definite disconnect that we've seen at the moment.
I mentioned China, and kind of one of the barometers of the Chinese economy, not only copper, but the iron ore price. And it says up 80% since September last year. It's was sitting at around the benchmark price, or $158.50. Your thoughts on this kind of rally we've seen in the iron ore price? There's views that it's domestic supply constraints in China which are partly to blame.
Yeah, I see a news article out today on the weather, poor weather, shutting down about 15% of their production capacity in China at the moment. I think this kind of supports the view that we've seen that China's not about to go into recession. Likewise, neither is India. There's going to be this demand for commodities, or base metals rather, going forward. So while resources have been priced where they are, it just doesn't make sense. We expect, this iron ore price, as you say, is up 80%. I think it's over $150 a ton at the moment. Is it sustainable? I'm not sure, but we would expect demand to be maintained for base metals going forward.
Just looking at Anglo-American platinum, so you're looking at the platinum price recovery, a lot of optimism around platinum price trading at a premium to gold this year based on global recovery, and then Amplats saying last year they swung into a full year loss, giving some guidance on that, and the stock price down today. Investing in platinum miners at all right now?
No, we're not. Obviously, the Amplat's trading update highlights the difficult year that they had. I mean, this is quite well documented. I know a number of value investors are sniffing around platinum at the moment, and we've seen quite a nice jump over the last few months from Amplat's in particular. Ourselves, we don't have direct exposure there. We like Anglo-American at the moment, so obviously we get the Amplat's assets through that. But direct exposure, we're not holding right now.
Well, we'll leave it at that. Thank you so much for joining us today, Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers.